Yeah, great. Thanks, Ellis. So I guess just to start off, anytime I go too fast or you want me to clarify some kind of point, feel free to ask a question. Ellis, any feedback you have or anytime you want me to pause and clarify something, feel free to ask me to stop. So as Ellis said, I work at Stevens in Little Rock, Arkansas. I'm on the regional bank team, specifically Southeast, West Coast banks. So we have 4 publishing analysts. I'm an associate working under an analyst. We have 4 associates as well, or 5 associates just across the space. We cover banks anywhere from $2 to $3 billion in assets, so your smaller banks in the country, up to the big guys, Regions, SunTrust, BB&T, Wells Fargo, the like. So our space is pretty well developed. We're one of the bigger FIG, I guess, investment banks in terms of research coverage. This is kind of the space that we play in. So we cover 121 different banks. Just I'll pan over to the map. The coverage is pretty dynamic. Northeast, Southeast, Southwest, a lot here in Texas, here in Arkansas. Pretty evenly split across the different analysts here. So I guess, Ellis, do you want me to talk about kind of the day-to-day of research or just go into directly kind of analyzing a bank?
Yeah, let's analyze the banks first, and then whatever time we have left over. Since it's commercial banking class, I want them to get a feel for how y'all look at banks from an operational standpoint and then from a valuation standpoint.
Good, I was hoping you'd say that because that's how the presentation is built out. So I'll start off just high level on banks, and I think as the presentation progresses, we get a little bit deeper. Starting off with how banks make money, this may be in a commercial banking class a repetitive topic, but there's 2 main sources how a bank makes money. One is through their net interest income, which is all balance sheet driven. The other one is fee income. I'll hit on fee income here just because I touch on net interest income later. Net interest income is usually the bigger component of a bank's revenue. Fee income, this is anything from fees on checking accounts, ATM withdrawal fees that you get charged for not using your correct bank's ATM, mortgage origination and sale platforms, capital markets, so equity offerings, debt offerings, syndicating credits across the space. And they also, most banks have a wealth management platform where you can go and have your money invested by a wealth manager. On net interest income, so this is kind of the more important topic for banks, especially for smaller cap, we call them mid cap banks, so anywhere from $2 billion to about $30 billion in assets is kind of this mid cap space. They usually don't have the developed capital markets platforms or wealth management, so more of their income is driven by the balance sheet. So the way a bank operates is they bring in deposits. They use that cash to lend out money, right? So it's a spread game. You're trying to pay less on the money you're borrowing and earn more on the money you're bringing in from loans or securities or whatever assets you have on the balance sheet. So that's where net interest income comes in, and that's where that flows through. So it's a net account. It takes your interest income from the different assets you have, loans, securities, interest cash at other banks. You subtract out all your borrowing costs. That's your net interest income. Yeah, I kind of touched on it here. The way we view a bank's net interest income, because it's obviously dependent on how many assets a bank has on its balance sheet, just because it's a dollar figure. So most analysts, or all analysts, they look at it in terms of net interest margin, which has been a huge topic in the industry recently, just with what the Fed has been doing. So your net interest margin is your net interest income divided by your average earning assets. So how much on a net basis are you profiting from each dollar of assets you have on the balance sheet? So that's one of the, I would say, far and away, one of the bigger profitability measures of banks. This is kind of just a sample of how we break down a balance sheet of a bank. Each of these accounts is totally different from another account on the balance sheet. It's kind of lopsided from how you might look at a normal income statement. You have your expenses or your liabilities at the top, and then your assets or your income generating piece at the bottom. I guess diving into a few accounts that we particularly look at, I guess to start with liabilities, you can look at the now accounts, the MMDA, the money market, savings accounts, time deposits, non-interest bearing. One of the, I guess, best indicators of a bank's quality in terms of funding is the amount of net interest bearing deposits they have on the balance sheet. It's free money. That means that they're going to be able to lend out that money, and whatever they lend it out at is their entire spread. They have no cost to pay who they borrow the money from. Money market, that's usually a little more rate sensitive, higher cost money. The people that deposit that are usually corporations that are more rate sensitive customers. It makes a lot of a difference whenever you have $25 million invested, 20 basis points on that money means a lot to some of these companies. So that's a more rate sensitive account, usually a higher balance there. You're going to a higher dollar amount on the balance sheet. Your net interest margin on a net basis is usually a little bit lower. The deposit accounts contribute the majority of a bank's funding, but you'll also see below that advances from the FHLB. And I guess also before I jump into any more of this, I should say this is from an actual model. So these aren't just made up numbers, these are an actual bank that we cover, their balance sheet composition. So it's an actual example. But the other borrowing sections, so FHLB advances, Fed fund money, sub-debt, is a much lower portion of a bank's liabilities, but it's also the most expensive portion. So you'll see I don't know if I have a mouse. Yeah. You'll see deposit costs, $9.5 billion in deposits basically, 80 basis points cost, $350 million of other cash for 5 basis points or 5%. So a bank tries to generate deposits as much as it can to lend out money. If you're just funding banks, and there are a handful of internet banks that do this, they use high cost money, so FHLB advances, and they use that to fund their asset purchases, which is a low spread game. So community banks are trying very hard to gather deposits because that's the best way for them to be profitable. On the asset side, I don't think it comes as any surprise that the biggest piece of a bank's assets is its loan portfolio. But there's also a handful of other components to look at. And I think it's pretty interesting as well. This bank in particular has a pretty high balance of securities relative to their total earning assets. So at this point in time, when you're looking at the balance sheet, you're looking at the net interest margin. If a bank had a higher portion of loans, their net interest margin would obviously be higher. This bank has a pretty sizable liquidity position with $1.2 billion securities, $412 million of other cash. That's basically money on the balance sheet that, if they decide to, they can plow that into the loan book. You can see net interest margin expand pretty widely. So this is one that, whenever the lending picks up in their markets, whenever they get loan growth back up to speed, they have some pretty nice organic tailwinds to increase profitability. So that's one thing we might look for in the balance sheet specifically. Let's see if I miss anything from takeaways.
What I'm looking at right now is the yield on your taxable securities versus your yield on mortgage loans and total loans. So that's why you say, if you liquidate some of your securities, you go from 3% to 5% on what you earn. Yeah, exactly. And that's not indicative of that 5%. Also, you have a front book and a back book in your loans. The front book is what you're originating today at this point in time. So with the Fed having just increased rates, you might be originating loans at a 6% rate, but your average book rate, because you've had loans on the books for 5 years, is actually down to 5%. So net, it's an accretive effect. If you roll securities off that
are coming from the back book at 2%, you may reinvest that to 6%, you earn a 4% incremental spread there. So that's the point that I'm making there. I think I touched on this in the slide, but everything, especially recently, has been driven by the Fed. So I guess, do you guys talk about actions of the Federal Reserve pretty often?
A little bit.
Yeah.
But go ahead and let's hear your take on it.
Yeah, so just over the past, I guess since December of 2015, the Fed has been kind of on a path of raising interest rates. And that's a really interesting time for a bank, especially coming from a period after December of 2008 up until December 2015. Banks didn't have an increase in any interest rates. Interest rates were at 0% basically. So as interest rates go up, loans that a bank makes or securities that a bank buys, those loans are all priced off of some type of reference rate. So a Fed funds rate, what prime rate is or what LIBOR is, also 10-year, and a lot of these track movements of the Fed. So when the Fed shifts up 25 basis points, typically you see the yield on these loans or securities shift up 25 basis points as well. So over the past, I guess, close to 4 years now, people have been looking for the banks that are the most asset sensitive. So a bank's loan portfolio is broken out, or securities book is broken out a few different ways, where you have, just because everything is priced on either a 5-year rate, a 10-year rate, LIBOR, those don't all move the same. So you may have everything priced off LIBOR, it's adjustable rate, it reprices daily with LIBOR. As LIBOR creeps, because it adjusts daily as well, you're going to be more asset sensitive by nature because you're going to realize the benefit from the Fed's movement sooner. So people have been diving into this right here to determine kind of which pieces of these will, as far as the asset side, which piece of these will move the quickest with rates, which are going to move the slowest, and you make a stock call based off of that, just because you know a bank's profitability is going to go up.
Andrew, would you say that when rates are going up, that's going to immediately impact all interest-bearing deposits immediately, right?
No.
No?
So that's a completely other dynamic than loans. So your loans priced to LIBOR are going to reset immediately. The adjustable loans tied to the prime rate are going to reset pretty quickly, usually 90 days. On your deposits, you have some money market accounts that reprice as the Fed moves, just because it's a big customer that's kind of in the clause that the company is parking deposits on this bank's balance sheet because the bank will pay them that rate. Now, the, I guess, game that banks have been trying to play the past 4 years has been how long can we go without adjusting our deposit rates, or only doing them on a one-off basis. So for whoever doesn't have a clause in their deposits, which anybody that isn't running a $20 million deposit book is not going to have a clause. So I guess they've been trying to lag this Federal Reserve move on the deposit side, and for the most part, it's worked up until this past year.
So an interest rate increase affects the asset side a lot more than it affects the liability side.
Yeah.
That's what you're saying. So that's a good thing. So the banks like interest rate increases.
Yes.
Because it widens their spread. It steepens the curve and widens their spread.
Up until a certain extent, yes. Yeah. So we're at a point now, it just so happened to coincide with when the Fed decided to put rate hikes on pause, where banks, I guess it's kind of the diminishing return theory. As you get higher and higher, rates go up and up and up, your marginal benefit from each rate hike goes down and down and down, because you have more of these people who are starting to get rate sensitive. You have CDs cash flowing and repricing on the books. So your spread from a rate hike, your beta to a rate hike, goes down over time. So we're at a point, I guess we've been at a point for the past 6 months or so where it's starting to become questionable whether banks are asset sensitive, whether a Fed hike will benefit them, and there are less and less who will get a benefit now. Because at this point in time, there are a lot of secure CDs that are repricing people are very rate sensitive on money market accounts with rates up to 2%. So everything is starting to reprice quicker on the deposit side, except for the non-interest bearing. Again, you don't have to pay any money on non-interest bearing. It's always going to be at zero. So that's what banks have been trying to do for the past 6 months or so, is get all the non-interest bearing deposits they can.
Generally speaking, and I know that it's hard to make an approximation when you're talking about loan portfolios that vary widely from bank to bank, but what percentage of loans are adjustable rate, and either their adjustable rate in the contract or their adjustable rate because they balloon in pretty short order? Like you have a 20-year AM but a two-year balloon. In effect, you've got an adjustable rate loan.
Yep.
What would you say, what does that look like as compared with a fixed rate 20-year loan?
Yeah.
What percentage of a bank's loan portfolio really adjusts pretty quickly?
Right, so I'll break it out into kind of two pieces and just give kind of a ballpark average. There's adjustable and there's variable. They sound like the same thing. It's a little bit confusing. Adjustable reprices within 30 days. So that's your fast term money. It reprices very quickly. I would say on average across regional banks that are just in typical forms of lending, no special lines, probably 20% is adjustable, 20-30%. And then another 30 or so percent is going to be 20 to 30% will be variable rate. That there's a clause in the loan that it reprices every 3 months, 6 months, 9, 12, 18, just at some point in the future within like 5 years, it'll reprice.
So half the loan portfolio is going to reprice on a pretty regular basis.
Mm-hmm.
And then is the other half, that's fixed for some period of time?
Yeah, correct.
And then y'all look at typically what that looks like for the bank's portfolio. Is that 5 years or 10 years, 7 years?
So like determining a duration basically.
Right.
Yeah, and that's, some of the data is a lot harder to get. So banks file a 10K, 10Q, just like every other public company does. But they also file call reports, Y9Cs, which is called regulatory data. That goes into some detail, and we do get a breakdown of kind of what reprices when. So that's something that, it's not included in here, but it's something we try to approximate. There's kind of some rough math in there, but yeah, that's, when you're trying to figure out who's best set to realize margin expansion, you're looking for, if Fed's moving up, you're looking for who has the shortest duration loan book that'll reprice.
Y'all hear what he's saying? This is really important. When interest rates are moving either up or down, you're looking for banks that are best positioned to, if rates are coming down, they'll be hurt the least, or if rates are going up, they'll be helped the most. That's what you're trying to do.
So I guess you can also kind of flip that around and say today they decide to cut interest rates or begin cutting interest rates. You're going to look for the exact opposite. You're going to look for who on the asset side has the longest duration. So who's going to reprice in the longest amount of time. That means if they price loans right now, that's locked in for whatever the duration is. Whereas you would want them to have high return money, so like this other borrowings category that reprices instantly, because that's going to reprice when the Fed moves down as well. So the situation kind of flip-flops depending on the direction the Fed's taking. And I think this also does an interesting job, the table on the right, of showing kind of the diminishing returns from a rate hike. So if you look at the LIBOR moves, I guess towards 1Q18, 2Q18, when the Fed was really raising rates, you were getting a huge benefit on LIBOR side. These banks were seeing a nice pickup in loans tied to LIBOR. Now with the Fed on a more, I guess, cautionary stance, future rate hikes became more uncertain. LIBOR didn't move as much. So that's what you saw in 3Q18, 4Q18 to an extent. But then this quarter as well, before the Fed actually came out and said it, you haven't seen much of a move in LIBOR. So that's kind of the diminishing return recently, just because of the uncertainty. I'll go ahead and talk about it here. The shape of the yield curve is also pretty important. You guys know what happened with the yield curve recently?
Yeah, you got your worst.
Yeah, it inverts. So the 3-month The 3-month and I think it was 5-year are sitting like this right now, so they're inverse. This is of huge importance for banks because a lot of stuff that a lot of securities and a lot of mortgage loans, even car loans, so auto paper, a lot of that is priced off of 5 to 10 year rates on the curve. So as those rates get depressed, the short-term rates rise or these long rates get depressed. If a bank is buying assets or originating assets that are pricing off this long end of the curve, if that's being depressed, the spread they're picking up is not going to be as much. So that's something that has hurt a lot of banks recently, is they just don't have good opportunities to buy out on the curve anymore. They can't get duration because it's too cheap. So that's been another big topic as well. Anything else on, I guess, balance sheet or interest income, fee income? I didn't touch on that much, but okay. I'll move over to how banks lose money. So the biggest expense outside of interest, I've kind of excluded that from here. The biggest expense, operating expense on a bank's income statement is salaries and employee benefits. Probably this luckily kind of goes in order. The other two big ones are occupancy, so what a bank pays for its facilities, depreciation's in there, and then data processing. That's another big one. So like banks will use data processing systems for credit cards, debit card transactions. So that's another big expense for these guys as well. And I guess just how we look at operating expenses in terms of the money that a bank is making, there's a few metrics that I included here that people really focus in on. So that's the efficiency ratio. It's basically telling you how many dollars of expense is a bank having to, or what kind of percent of let me rephrase this. How many dollars of expenses a bank is having to incur in order to generate their revenue. So usually your efficiency ratio, say it's 50%. To generate $1 of revenue, you have to spend 50 cents on average across your income statement. So that's possibly, whenever we're first looking at a bank, just from a high level view, one of the first things you look at is their efficiency ratio, because it's kind of an all-encompassing profitability metric. You're looking at your revenue, that's part of the equation. You're looking at their expenses. Net interest income is picked up in the revenue side. So you have a high level of how lean the bank is being run, how profitable the business model they're running is. So that's a very important one. Expenses to average assets isn't as important. Operating leverage is though. So efficiency ratio is kind of backwards or static looking. So you're looking at what the efficiency ratio is for the most reported financials, or most recently reported financials. With operating leverage, you're looking at the dollar of quarter-over-quarter growth in revenue over expenses. So you can see a trend and easily compare that to other banks. You're wanting the banks that are generating the highest operating